This quarter, India Inc.'s aggregate profit growth was 2%. 2%. And in that very same quarter, small cap companies delivered 32% earnings growth. Same economy, same 3 months, 16 times the difference. So today we're going to work out whether that number is real or an illusion, and then answer the question that actually matters for your portfolio. Can it last? Let's start with what the data says. Aggregate earnings grew 2% year on year against an expectation of a 10% decline. Strip out the oil marketing companies and earnings grew 17%. Now look at the split by company size, because this is where the story lives. Large caps grew 6%. Mid caps fell 31%, dragged down by losses at oil marketing companies. But excluding those, mid caps actually grew 25%. And small caps led everything at 32%, supported by financials and a favorable base. Read that again. The headline told you mid caps were down 31%. The underlying business reality was plus 25. One sector distorted an entire segment's number. But the most important statistic of this season isn't the growth rate, it's the breadth. Of the 994 companies that reported, 58% posted positive results. That's up from 54% in the March quarter and up from 46 and 45% in the December and September quarters before that. 4 consecutive quarters of improvement. That isn't one company's good news. That's the base of the market getting healthier. The quality of the beats held up too. Around 49% of companies beat estimates, while 22% missed at the profit level. Now let me make this concrete with actual companies. These are illustrations of what the numbers look like. They are not recommendations, and nothing here is a view on any individual stock. Start with Marksans Pharma because it is the single best summary of this entire quarter. Revenue of 840 crore rupees, up 36%. EBITDA of 213 crore, up 113%. Net profit of 159 crore, up 174%. The EBITDA margin went from 16% to over 25%. Cash on the balance sheet crossed 1,000 crore rupees for the first time in the company's history. The UK and Europe business hit a record 356 crore, up 75%. On the face of it, that is a spectacular quarter, and a lot of it genuinely is. Now take HFCL in telecom equipment. Revenue up 120% from 871 crore to 1915 crore. Operating profit went from 28 crore to 414 crore. That operating profit line is up nearly 14 times. But hold that number because I'm going to come back to why it looks bigger than it is. And then the genuine article. Welspun Corp reported net profit of 1,048 crore rupees, up 200% from 349 crore. MTAR Technologies grew revenue 130% to 361 crore and net profit 350% to 50 crore. Pipes and precision engineering, not glamorous. But these are order books converting into cash, and that is what a real capital expenditure cycle looks like when it's working. So which sectors drove all of this? Growth was led by metals at 53%, banking and financial services at 20%, technology at 11%, and automobiles at 7%. More broadly, sectors tied to domestic investment, manufacturing, infrastructure and financial services outperformed, while export-oriented and consumer-facing businesses faced headwinds. Notice what the winners have in common: domestic demand, the capex cycle, financials. And notice who got left behind: exporters and consumer companies. This isn't random. The market is systematically rewarding one specific theme, and that is a regime signal, not a coincidence. Now, here is where most people stop reading and where the actual work begins: the margins. Revenue growth stayed healthy across the board, reflecting genuinely resilient demand. But the gap between sales growth and profit growth tells you that higher costs are still eating into margins. Come back to Marksans. Its gross margin this quarter was 59%. Excellent number. But here is what the company itself said about it. Management guided that gross margin should normalize to a sustainable 55 to 56% as lower cost inventory is depleted and higher raw material costs flow through. and the full year guidance was left unchanged at 15 to 20% revenue growth with an EBITDA margin of 20 to 21%. Think about what that means. The company just delivered a 25% EBITDA margin, and it is still telling you to expect 20 to 21 for the year. Management is effectively saying this quarter is not the run rate. There's another layer. Underlying growth was 28.5% once you exclude the 44 crore contributed by a recent acquisition. Still very good. But acquired revenue and organic revenue are not the same quality of growth, and a percentage number won't tell you which one you're looking at. And despite all of it, the revenue figure still fell short of market forecasts. Record profit, record EBITDA, record cash, and the top line missed. This is the same pattern across the market. Across 6 frontline IT companies, only 3 grew sequentially in constant currency terms, yet operating profit rose year on year at every one of them. And where margins improved, the gains traced mostly to the timing of wage hikes, restructuring rolling off, and currency movements, rather than companies regaining pricing power. Cost-led margin expansion and demand-led margin expansion look identical on a results screen. Only one of them repeats next quarter. Now let's take the bull case seriously, because people are arguing this is the start of a new leg up, and they have real evidence. The first argument is breadth. 58% of companies reporting positively, improving for 4 straight quarters. Bull markets almost always begin in breadth before they show up in price. The second is that the downgrade cycle is turning. The pace of earnings downgrades moderated this quarter. When analysts stop cutting, that has historically clustered around inflection points. The third argument is the quietest and the most interesting. The Nifty Smallcap 250 has delivered a 1-year compound return of just 2.3%. Meanwhile, earnings grew 32%. Price flat, earnings up. That means valuations are cooling on their own, without a crash. That is the healthiest form of correction there is. For context, the Nifty 50 trades at a trailing price to earnings ratio of around 20.6 in the fairly valued to slightly overvalued zone, against a historical average of roughly 20 to 21. That's the optimistic case. Now the other side. And ignoring this side is what costs people money. Start with the base effect, and let me use Marksans again, because this is the cleanest illustration I've seen all quarter. That profit number was up 174%. Up from what? In the June quarter of the previous year, Marksans' net profit had fallen 34% to 58 crore rupees from 89 crore. So the spectacular growth is measured against a year that went backwards. That doesn't make the quarter bad, it's still a record. But it does mean the growth rate is flattered by where it started from. And when you see a whole segment posting 32%, ask how much of that is business improvement and how much is just a weak comparison base. The same trap is sitting inside that HFCL number. Operating profit going from 28 crore to 414 crore is a 14 times increase in percentage terms. But 28 crore was a near zero base. When the denominator is tiny, the percentage becomes theatre. This is why I'd rather you look at absolute rupees and margins than at growth rates. Second risk, valuation. The Nifty Smallcap 250 trades at a price to earnings ratio of 34.4. That's about 22% above its 5-year median of 28.3 and 15% above its 1-year median. Measured against 15 years of price to earnings and price to book history, the segment screens as expensive. Earnings grew 32% and the multiple is still 34. A lot of good news is already in the price. Third, and almost nobody is discussing this one, the asking rate. The implied growth needed across the remaining 9 months of this financial year, excluding oil marketing companies, is above 20%. Fall short, and earnings per share estimates get cut. Everything you are being shown about this segment quietly assumes that 20% gets delivered. Fourth, understand the volatility you're signing up for. The Smallcap 250 has annualized volatility of over 17% and a beta of 1.07 to the Nifty. Across every 1-year holding window since 2005, the median return has been about 10%, but the best window was plus 175% and the worst was minus 69%. That minus 69 is the number people forget in the middle of a good run. And finally, the macro overhang. Geopolitical uncertainty, elevated energy prices, and a heavy pipeline of IPOs and capital raising could all keep markets volatile in the coming quarters. So, where does that leave us? The earnings are real. 32% is not an accounting trick. Breadth has improved for 4 consecutive quarters, downgrades are slowing, and companies like Welspun and MTAR are converting a genuine capex cycle into genuine profit. Anyone dismissing this as pure speculation isn't reading the data. But sustainability was never a question about earnings. It's a question about expectations. This segment has to deliver more than 20% growth over the next 9 months just to justify the estimates already sitting in today's prices. It has to do that at 34 times earnings. And in several cases, the margin expansion driving those profits came from inventory timing and cost lines rather than pricing power, which the companies themselves are telling you if you read past the headline. That doesn't mean run away from mid and small caps. It means the easy phase is over. The phase where you simply bought the segment and it worked, that has ended. What begins now is the phase where the difference between one small cap and another matters more than the decision to own small caps at all. Marksans, HFCL, Welspun, MTAR, 4 companies, 4 completely different stories hiding behind similarly impressive percentage growth. One had a weak base, one had a near zero denominator, two had real operating leverage. You cannot tell them apart from a headline number, and you cannot tell them apart from a screener sorted by profit growth. That is exactly the problem a systematic process is built to solve. Not an opinion, not a story. A repeatable filter that looks at every company every quarter at margin quality and earnings durability without getting attached to any of them. That's the work we do at Wright Research. If you'd like to see how our models are positioned across market caps right now, the link is below. I'll see you in the next one. This quarter,